Can you give us a few examples of when our capital preservation tools haven't worked as well as planned, and also when they have?
What we're showing you on this slide here is a couple of recent periods of volatility and how these tools have actually worked. And so what we're showing you on the right-hand side is the March 2020 quarter, and on the left-hand side is the December 2018 quarter. And so these are the two big drawdowns that the fund has had to deal with pretty much in the last 5 years. And what you can see is obviously in both scenarios, our long equities go down. We are investing in equity markets. We're not immune to equity markets going down. We're not immune to stocks going down. And so in both scenarios, you can see the fund, our long equities fell 12.6% in the March quarter, and they fell over 14% in the December quarter of 2018. But offsetting that are some of these tools basically in action. And so in the COVID quarter, you can see the short equity return and the put option equity return, and finally the currency equity return, all helped offset the losses on the long portfolio to ultimately give us a positive outcome for that quarter. If we go back to 2018, we got less benefit from the short equities, we got less benefit from the put options, and less benefit from the currencies, but ultimately minimised the drawdown to 10% through that period. The difference between the two different scenarios is really importantly how far the market fell in each one. As we know, in March 2020, markets fell a long way, and so the capital protection tools were very successful. The period in 2018 was more a rotation in market on the back of high interest rates. And that rotation in market means the overall market didn't fall as far as our stocks fell. And so from that point of view, while they provided some buffer, it didn't obviously work as well as it did through the March period. The important thing to remember is as we go forward, in every future correction, every single one will be different. And in every single one, we will use different tools at different times. And every time the outcome will be different. And some will be as good as March, and some of them will not be as good. But the important thing to remember is that we have the tools and everybody else doesn't. And we have standard disciplined risk procedures as to how we use them. And so that ultimately should give clients some comfort that we can smooth returns through the cycle. The active disciplines we have around here is, so first and foremost, you can lower exposure. And so that's essentially raising cash, buying puts, shorting futures. Those are the normal things that we would do in any scenario where we just felt we were going into a difficult period and wanted to lose exposure. Any combination of those threes. The last and most important thing that happens is really our stop loss protocols. So it's important to remember that the fund has stop losses on certain stocks should they fall 20% from peak or from cost, but also the fund as a whole has a stop loss should it fall 5% from peak. And in all of those scenarios, we are compelled to look at the overall net exposure of the fund, and that is often when we actually move to actually sell stocks or sell holdings and raise cash. And so there is the early things we do, which is futures or put options or currencies. And then there's the disciplined things we do afterwards, which is how we go work through our stop loss procedures. And all of that ultimately lowers volatility, lowers exposure to markets through difficult periods.
Can you tell us the tools that you had available at the start of the March 2020 quarter?
Yeah, so by way of example, the March 2020 quarter was something we all remember. It was the start of the pandemic, and there was a lot of information flying at us quite quickly. To specifically talk about exactly what we did, well, the first thing we did was we actually already had a put option on the market. So we'd bought the put option earlier on in February or in mid-February to basically, because we knew that COVID or the pandemic was around, but people didn't think it was going to be a big deal. So the fund remained fully invested, but it had a put option. After that, I think we all woke up and remember when Italy had to go into lockdown, or Northern Italy go into lockdown. And that's the point where we shorted futures over the fund and started to raise cash quite aggressively. And so there we shorted over 10% futures on NASDAQ futures and raised cash. And we also had our put options that started to explode in value, which obviously lowered net exposure further. As the pandemic continued to push itself across the planet, we then started to address the underlying portfolio and had to address the stop losses that were occurring in our portfolio, i.e. the falls from peak of 20%. And that's when we had to deal with stocks like Airbus in the portfolio or some of our luxury good companies, where we just simply thought that we didn't really know what was going to happen, so we moved to the sidelines. And that's our ability to raise more than 5% cash, and so we ultimately raised cash. And so all of those actions together really got net exposure for the fund actually below 50% quite quickly, which is an area where we could stay until we'd actually worked out what was going on and how long the pandemic would last for. Ultimately, the next hardest decision, and a much harder decision, is when to put exposure back in the market. Taking money out of the market is a reasonably easy thing to do. To not lose money, if you actually just think about it as not losing money, is actually not that hard to do. What's really hard is working out when to reinvest. And so from that point of view, Markets were obviously very volatile. There was a couple of things we were looking for. The first and foremost was the pandemic to ease. So some slowing in the second derivative of cases in the early countries like Italy or China or South Korea was very important, just to make us realise that, yes, the whole world wasn't going to get this, or the whole world wasn't going to die. The second and most important thing you're looking for is some very aggressive action by monetary authorities from the Fed, and we obviously saw that through that second last week of March. In March 21st, I think they put the bond buying program. They did the rate cut the week before that. And all of those two things together really gave you that bottom of the market as we approached the end of the quarter. And it was one that we actively bought into because we actively had the stocks that we wanted to hold coming out of the pandemic in our mind already.